Hello, everyone. I'm ready. I'm Polina. For those of you who don't know me, I'm the head of research and lead economist. Let's jump right in. I have a lot to say as usual, so I'll try to be concise. So quick overview of what we're going to talk about. The economy and the R word. We will talk about some of the economic reports and indicators that are coming out and what they really mean, the back and forth in the real estate market, what it looks like from both buyers and sellers. And we will look at Sundae markets and what the pricing and inventory trends tell us. And we will look at some of the forward-looking indicators. So just like everything, right now, the word recession became a bit politicized. Why is there a case for saying there is no recession? If you look at the high frequency indicators for the economy, and the x-axis is what 2019 level looked like, we are almost there for hotel occupancy, TSA travel, traffic, open table reservations. Also looking at the ratio of job openings to job seekers, we have almost two job openings for every person looking for a job. So it doesn't look like we're in a recession. On the other hand, we do have 2 quarters of negative GDP, and historically that has been the definition of a recession. And also there is some weakness in the manufacturing data. So we have high inventories, actually the highest inventories since 1984, and the new orders and the manufacturing employment are contracting. And it's been about 3 months since they started contracting, and the backlog of orders is barely positive. So I personally think that some of it is backlash from the pandemic. Remember, we talked about it when people were stuck in their houses, they were buying too much, they were ordering too much, and now there is this reversion to the mean. But one of the major recessionary indicators is the spread between new orders and inventories. And that's what you see on the second graph. And this negative spread is there right now. So it's yet unclear how much of that is COVID-induced and temporary change in consumer spending pattern, and how much is that really happening because we are going to have a recession. So what does this really mean? We're in a Schrödinger economy. And so for those of you who do not remember it from quantum physics, because I know that not everybody took quantum physics, or haven't watched the Big Bang Theory, there is a cat experiment, and the cat is placed in a box with poison. And until you open the box and find out whether the cat is dead or alive, it can be both. So same here, we may be in a recession right now or not. And until we actually observe one, we don't know. But it does look like fears of a recession appear to be much bigger than the actual probability of a recession. Specifically, systemic recession, like the one we had during great financial crisis that impacted everybody and everything. So everybody who is, like all economists that agree that we will see a recession, they think it's going to be very moderate, not where we have 10% unemployment, but we'll have a pretty minor one. So that said, we certainly appear to be in a mental recession. And I posted this in the Real Estate Intel channel. Consumer sentiment today is worse than in the midst of the worst modern financial crisis and epic market crashes. It does appear to be very much disconnected from the overall state of the economy relative to historic levels. I mean, you've seen that the stock market is doing pretty well. And overall, things aren't bad, trust me. And I think the reason we're seeing this is because of the headlines, because of the social media. You know, in the last 10 years, we've seen a lot of progress there. And because we're very divided, because half of the country does believe that the election's been stolen, because they're very unhappy with the president. He has horrible approval ratings, and that is eating into the consumer sentiment and the overall feeling. All of the indicators that are coming out, they appear to be strong or good. If you start digging in, there is some indication of the weakening in the economy, which does signal that at some point Fed will stop being hawkish. So there is a nuance to the employment report. We got a very strong employment report. We recovered all of the jobs lost to COVID. But if you look at the leisure and hospitality employment, it's 1.2 million below pre-COVID levels. We also see that total full-time employment is down for the second consecutive month, which is not a good sign. And if I had to guess, I'm pretty sure this employment report is going to be revised because we are seeing unemployment claims ticking up as well. We also got a very good, or somewhat good inflation reading. The reason even though it's slightly down from 9.1 to 8.5, I believe, or 8.7, month over month inflation is 0, which is, it's pretty good. The reading is lower primarily because of the energy sector prices, which is great. But while there is some control over energy prices, and what I mean by control, the president can decide to release oil from strategic petroleum reserve. We do have that. And that's what's been happening. Or we can stop charging taxes on oil. There's very little the Fed or the government can do with other sectors. They can't influence the price of other things or produce goods and services. So on the second graph, you can see that owner's equivalent rent, we talked about this, rent of primary residence is about 32%. And on the bottom, this is a graph from Apartment List. You can see how rents appreciated. Rents for single family residences also appreciated. And prices of homes continue to go up. And these are leading indicators. So it takes about 6 months for these prices to trickle into the consumer price index. It takes about, so 6 months from now, we are going to see that reflected in inflation. That's why I believe that we will be seeing somewhat persistent inflation unless it's going to be offset by other sectors. But housing is going to continue driving up the overall number. So let's talk a little bit about the price trends in Sundae markets. And I want to apologize in advance. These are listing prices. I wasn't able to get sale prices because it's from realtor.com. For some reason, Redfin data center was malfunctioning. But one very important thing is there is a lot of, our numbers appear very strong. So what you see here is year over year and month over month. So the median listing prices are coming down, which is actually good. It means sellers are becoming more realistic. And you do see, if you look at the graphs, you do see this convergence. There is a smaller spread between listing and sale. But the sale prices year over year are very much positive. So the prices are not declining. And I believe that I have seen one decline, but you have to, again, put this in context. You want to be looking at sale prices along with the square footage, because one of the important things to note that, for example, in markets like Nashville, you can see that there's definitely appetite for either bigger homes or it's the move-up buyers who are moving there, or the luxury segments, because the median house increased 10%, and it's a pretty big increase. Same thing for Seattle. My guess would be that you probably have more executives moving to Seattle. There's always this migration from Silicon Valley to Seattle, and that must be the explanation. Either that or we had very few sales. It's very important to think about seasonality. So you see the waves. There is a lot of seasonality. We cannot ever think about month over month trends. And that's what's really upsetting about the news right now, because they're talking about prices declining in a lot of markets from last month. What you usually see in almost every market is prices peak after spring sales season, especially in the California markets. In Texas, I believe it's around the 4th of July. But what you want to look at is when they peak, and you do expect them to go slightly down for the rest of the year. And that even happened during the COVID year. So that's why you see these little waves. So don't be scared if you do see prices decline a little bit. month over month. You always want to look at year over year pricing. In fact, I think that they need to be smoothed for 12 months. So this is a very interesting one because inventory trends in Sundae markets, and this is a very important one because everybody is talking about inventories rising, and honestly, the two markets that are somewhat concerning are Las Vegas and Nashville. Everything else stopped adding inventories about a month ago. So what you see here is, even though the active listings have been increasing, the new listing count month over month has gone down. So at the same time, the total listing count is up. This is telling me that both sellers and buyers pulled back from the market. Again, this can be a very seasonal trend. You usually do see this in August. Before kids go back to school, people go on vacations. So everything has to be taken with a grain of salt here. But it does look like the market is tighter. But when Las Vegas shows an opposite trend and Nashville is showing an opposite trend, this is a warning sign for me. So this is how I read these tables and graphs. So keeping in mind what I said about inflation, the very first graph shows you how quickly inflation cuts your money in half. If it's at 2%, it takes 36 years. If it's at 3%, 24. So we're at about 8% now. So in 9 years, you'll have half of the money that you have in your savings account or in your checking account if you just keep it there. On the right, you see average annual returns. This is not risk adjusted. Real estate outperforms on risk adjusted basis. I do have a long paper on this. If you're like me, if you're geeking out on data and papers, I will be happy to share it with you. Bottom line is, everybody knows that real estate is a great inflation hedge, and investors are onto this. That's why you see that investor purchases, even in this market, are increasing. And we even see it in their flipper data. This is a survey that we co-brand with John Burns, and you can see that in the second quarter. We don't have second quarter data for the previous for CoreLogic, but we do have it for second quarter from the Flipper survey. And you can see that mom and pop investors, as well as institutional investors, flippers do increase the share of properties they sell to those. Okay, and this is more of like forward looking. I did kind of grow up when I started my career on the trading floor. And to me, like, the yield curve is my everything. And thinking it for me, it tells the future. So the yield curve, it's a line that plots interest rates of bonds that have the same credit quality and different maturity dates. So it shows what investor is expecting to earn if he lends money for a given period of time. So on the bottom, you can see what makes sense, right? If you give somebody money for a longer period of time, you expect higher return. And on top, you can see what the yield curve looks like now. It looks like a camel. So we have a humped yield curve. So a humped yield curve does not compensate investors for the risks of holding a long-term debt security. So what this is telling me is that the bond market right now believes that the Fed will continue to raise short-term rates. It also believes that in the long run, inflation is not a worry, and that the Fed will lower short-term rates sometime in 2023. Also, when yield curve looks like this and not in its normal state, it does say that there is going to be a period of uncertainty and volatility. So to bring this all together, what does this mean for Sundae? I do believe that the rates will fall in 2023 and we will see prices go up. In fact, if we map housing prices in times of recession, they only declined twice, in 1930s and during great financial crisis.